This situation is a little bit different, and gold is up. I don't know, from the open on Sunday the 8th to as we speak, it's probably up $100. And there's a couple of other factors. The geopolitical part of it has a little more staying power because of the uncertainty. Additionally, the current structure within the COMEX market, I'm referring to the Commitment of Traders report, is very bullishly positioned. It's the speculators, the hedge funds that are the short party primarily, and the banks are maybe a little more long than usual, and so that tends to support price as well.
Gold prices rose in European trade on track for a second straight daily profit, hitting 5-month highs and approaching $2,000 on haven demand as geopolitical tensions mount in the Middle East. CraigHemke of TF Metals Report provides valuable insights into the precious metals market, linking recent gold price increases to geopolitical tensions. He predicts the gold real interest rate correlation broke due to a shortage of physical gold. Gold prices have in recent years shown an increasingly strong negative relationship with inflation-adjusted bond yields, with gold rising when real interest rates fell and vice versa. Meanwhile, Hemke believes that the reliance on derivatives to determine gold prices makes the ability to deliver physical gold crucial. Today, the demand for gold, the amount of gold in the central bank reserves, the value of the US dollar, and the desire to hold gold as a hedge against inflation and currency devaluation all help drive the price of the precious metal. Gold prices historically correlate with gold demand, offering insights into future demand. In 2003, the average gold price was $363.83 per ounce, while today it's around $1,900 per ounce, marking a 421% growth in 3 decades. Experts expect this upward trend to persist as gold demand continues to rise. Furthermore, he states that gold saw minimal demand in the past, but recent years have witnessed the highest central bank demand in half a century. Central bank gold demand reached a 55-year high in 2022, with a whopping 1,136 tons added to reserves across the globe. This represents an 18% jump, with total holdings reaching 4,741 tons by year's end. The record-breaking fourth-quarter binge of 1,337 tons could have been the closing exclamation point on annual demand, but the beginning of 2023 proved it to further the trend. The demand for gold surged even higher with quarter-one purchases, setting a first-half record with 387 tons. Now, we present the clips of CraigHemke's insights from his recent interview with Silver Bullion TV. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Real interest rates is historically, that's what gold is tracked. People say it's an inflation hedge, but that's only part of the picture. Inflation as it relates to nominal interest rates gives you the real interest rate, the inflation-adjusted interest rate, and that's what gold has always followed. And so these charts that you'll see that you mentioned that go back 20 and 30 years plotted gold and real interest rates together, and the correlation is like 95%. They're like this. Well, then all of a sudden, now had the correlation continued, it implies a COMEX gold price based on where real interest rates are of like $1,000 an ounce or $1,100, something like that. And I see these kind of traditional, quants out there. They're like, I don't understand what's going on here. And they're just generalists, they just see a chart and a discorrelation and they come up with, they pull all these reasons out of their rear end as to why they think that's happening. I'll tell you why it's happening. I wrote about this a couple weeks ago. I mean, again, what do I know? I'm just a guy, but here's what I think. That this pricing scheme, the one that determines that gold price, is through trading of derivatives. My friend Ned Naylor Leyland famously said, it's the future's tail that wags the spot dog. And so you've got these derivatives that you trade in New York and in London, forward contracts or futures contracts. And the spot price follows the trading in that. Okay, these hyper-leveraged and rehypothecated, gold accounts, and they trade off all these derivative products. Okay, for that, if you're going to discover price of a physical commodity that way, okay, rather than trading the actual physical, I say, hey, Patrick, here's an ounce of gold. What are you going to give me for it? And you say, I'll give you $2,000 for it. If you're going to actually price it based off, the trading of this this empty whatever, nothing, right? Then you have to be able to deliver the physical commodity at that price. Now, the way the precious metals markets are structured, entities that are in charge of managing the physical inventory in London are what's called bullion banks, big 10 or 12 banks, okay? They are the ones that are in charge of managing the markets and flowing the metal. The fact that price hasn't gone down to 1,200, or see it in present, just watch the flows of the positioning. The fact that every time price dips, the banks get long and go long the contracts tells you they don't have the metal to deliver at 1,200. We have this record central bank demand, pretty solid retail demand. And these banks have to know that if they allow the computers and the hedge funds to take over and close that gap and drive the paper price down to $1,200, well, they've got to come up with metal to meet all of the physical demand that's going to follow at 1,600 and 1,500. And so the banks are on the other end buying while the speculators or hedge funds are shorting, and that prevents that price from falling all the way down and keeping that correlation. So it's really a function of physical demand, a lack of physical metal that has created that big yawning gap. There's no demand for gold. Very little back then. We didn't have the highest central bank demand in 50 years, back to back last couple of years, that sort of thing. So that's what's different, and that's why that correlation broke a year and a half ago, and that's why it's going to continue to remain, in this big yawning gap.
CraigHemke predicts that rising physical demand and falling supply could drive silver towards a more fundamental price, like gold, with a potential turning point if it exceeds $28. In October 2021, Bank of America published its outlook for precious metals in 2022 and beyond. It forecasted that silver prices would average $26 per ounce in 2022, $28 in 2023, and $30 in 2024. Meanwhile, he discusses the dominant role of London in global gold pricing and questions why other hubs need to establish their systems. The London OTC market has historically been the center of the gold trade, and today comprises approximately 70% of global notional trading volume per our estimates. Let's get back to the interview.
Silver has the same problem for the banks, poses the same problem for the banks. We saw 4 times last year in the fourth quarter where silver went down to about 18 or 19, and the banks got heavily long. This is just COMEX positioning, and the speculators got short, and then boom, here comes a short squeeze, goes right back up. So one, to me, since that continues to happen this year, that precludes silver going to 12 or, whatever. That's just not going to happen. But why isn't silver exploding? Why isn't silver, if gold's at all-time highs, why isn't silver at 50? And to me, that's how we got to get there. We got to get there through physical demand. Now, we ran a supply deficit last year. What did the Silver Institute say? Like 237 million ounces, something like that. We need that to continue. We need investment demand to continue. We need to keep soaking up what physical supply there is so that that ability to drive the price lower or the ability to keep the price at these levels begins to evaporate. For now, again, it's the same thing. If you trade the futures contracts, and as we record this, that's $23 an ounce. If there's enough metal in the vaults in London, New York, that the banks can physically deliver out and, metal at that price, then okay, well, then there you go. That's your price. What we need to get to is where there's not, like what we're seeing in gold. And that's where finally physical fundamentals take over. But for now, we continue to trade silver off of this derivative price. There are a handful of bank trading desks that kind of have a monopolistic control of that pricing scheme. They do it for great profit for their trading desks, and it keeps, price in a box. I mean, we've been in this range now for 3.5 years. And if and when, I should say when, the time comes, and we break out above 28, that may spur things along. But for now, that they just really have it, like I said, a real tight box. There are other hubs around the world. Dubai Why doesn't India have, their own? Why is India taking the price fed to them from London? That sort of thing. Moscow has developed their own gold price as well. For now, the pricing monopoly, if you will, again, it's a little bit like the U.S. dollar reserve currency argument. Why is the U.S. dollar? Well, because it has been forever, and no one really remembers a time when it wasn't. And so, why do we still continue to price, the daily fixes in London and use that as a wholesale benchmark for the world? Well, just because that's what the world uses. There will come a time when that power will shift, for maybe a collection of reasons. But I don't think there's any reason why that shouldn't be the case. And it should also be a more physical-based market. We shouldn't be pricing the metal off of the trading of derivatives. And that might be a fun thing to talk about too, because this has been coming up a lot lately. Why is relative to, like, you've probably seen the charts, Patrick, of when the biggest drivers or closest correlations of the gold price for decades has been real interest rates, and gold and real interest rates would kind of move up and down like this. Now all of a sudden there's this big yawning gap, and every couple of days or so I'll see things on Twitter where people are like, what's going on? Why isn't gold $1,100? Well, I think that gets to do with how gold is priced and the mechanics of the market. So anyway, eventually it'll move. That's inevitable, the pricing control. But for now, it remains primarily based in London, New York.
Central bank gold demand tends to peak during times of peak economic uncertainty. As a reliable hedge against inflation, gold is the asset of choice when mainstream markets buckle. With a surge in gold prices, are we witnessing a shift in the perception of gold as a safe haven asset? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.